All right, somebody drop some ones. Let me know you can see my screen. If you can see my screen, drop a 1 in the chat. Awesome, and you should be seeing the Blackprint up there. Is that correct? All right. All right, good evening, everybody. My name is Al Pickett. I am the founder of the Blackprint, the New Rules for Winning Finance, Freedom, and Flexibility. And you were invited either this evening, you were invited by me or you were invited by a friend. And, my goal, what I want to do, I did one of these 2 years ago that was really good and people got a lot out of it. And I want to do it again. It's been too long since I've done another. And in this one, I really just want to enlighten, share what I know, share the insights, and give you a strategy that you can use to participate in the markets, whether you are, trading or investing long-term or short-term. Please use the handle if you want to share any information, any pictures that you see here. If you want to share anything you hear, tag me. That'll help out a lot. This is it's not a sales pitch. It's just me sharing what I know. And the Blackprint was started roughly about 8 years ago, and it really was started out of frustration of how much bad advice I saw online about, at this point, some of you all have heard of the term "buy the dip," or you would hear, "Oh, it's low, so I'm going to buy it," and no real other information about that and why, how to protect yourself, why you should do it. And so I was like, you know what, we're find a problem, fix a problem kind of people. That's my background, and decided I was going to do something about it. I originally was in the mortgage business. I'm 41 now. I was in the mortgage business for 10 years, from 20 until 30. Started trading and investing at 23. And, I just knew it was going to be my thing. I knew it was going to be my thing. I wanted the ability to be anywhere. Obviously no income caps. And I was just fascinated by, how it all works and how I ended up in this. My financial advisor at the time got me a return of 82% in 1 year. And, I had peanuts with him, and I thought that was, I didn't have to do anything else. It was just 82% in 1 year. And, like anybody else, you go, you know what, that's damn good. And I started to look at the money that I had in the bank, and I said to myself, so, okay, if I can get 82%, if I can do this myself and get 82, anywhere close to that on an annual basis, this is the only other business I need to do for the rest of my life. And that's how I got started. And, basically called my financial advisor up and was like, hey, man, I appreciate it, but I think I'm going to take it from here. Because he couldn't, their job is to get more capital on the management. So he didn't have time to teach me what I needed to know to do this for myself at a high level. So I just took it upon myself and started learning. Try a lot of trial and error and so forth. And now, from 23 into now, I'm just having a great time with it, and along with teaching other people how it works and so forth. So here's what you're going to learn tonight. You're going to learn how interest rates impact the economy. That's been a big thing as of late, right? Then you're going to learn some simple market patterns. You're going to learn how to spot trends. You're going to learn when to buy. And that you'll hear me say participation. So how do you participate? And you're going to learn when to sell. That's a big one because nobody really talks about when you get out. How do you protect yourself? So I really want to spend some time on every single one of these things. And feel free, again, to drop questions in the chat. As far as coming off of mute, feel free to raise your hand and so forth, and then I'm monitoring. And then we have Rika Davis is on the call. She's the only other person that I've licensed to teach the Blackprint, so she'll be monitoring as well and catch any questions that I missed. So moving on here, where are we economically? This is one of the things that I have studied and I pay a lot of attention to. Right now, the interest rates the central banks have been raising the interest rates. And one of the first things that the interest rates start to impact is housing, because it's the biggest investment that people make, right? It's in terms of the amount of money they spend, that's one of the biggest things they spend money on over a 30-year period of time. And so it's one of the first things. So you see these 4 letters, you see housing, new orders, profits, and employment. And I'm going to talk about each one of those a little bit here. But before I do that, I want you all to drop in the chat, as far as when somebody purchases a new house, what are all the things that, like, how many industries, somebody just throw out there, how many industries you think are a part of building one house? How many industries? Sean says at least 7. 8. So you got the foundation of the house, right? We're talking about from the dirt up. So you got the foundation, you got your appliances, and you got a whole lot. We can just, if you feel free to drop a couple of things that you can think of. When somebody buys, you have to furnish the place. You got, you people buy a new car, you got your appliances, you got your woodwork, you got your toilet, your bathroom fixtures, you name it, right? So all of these various industries and subsets of that, right? So you have all of that goes into it. So when the interest rates start to go up and people kind of slow down on purchasing houses, how many industries, again, those same industries and those the subsets of those industries, they get impacted because new orders stop coming in. So that's that. So the housing, people start slowing. The affordability, if they can't afford the same amount of house, they start to pull back, right? I wanted that house, but can't afford that one anymore. Then they start to, okay, well, we're going to take we'll take a pause. When interest rates go down a little bit more, then we'll come back to that idea. But in the meantime, all of the orders that goes into that is impacted. People start to, because this is a function of debt service, right? The ability to pay whatever that mortgage rate would be. Their credit card interest, if the interest rates are going up, the credit card interest is going to be higher. The car notes are going to be higher. Anything with interest, any kind of loan is going to be a higher expense. And so the first thing people start to do is they start to cut back on where they're spending money. They start to cut back ordering things, right? That's products, services, you name it. So companies start to see new orders decline when interest rates go up. Drop some ones if that's making sense to you. So now we've gone through the H, at the O, and then we're going to talk about P. So first, if new orders start to slow up, then profits start to go down. And this is not one of those things that happens just really, really quickly. It takes a little bit of time for it to start to show up in the headlines. But people who are in these various industries, they notice it first. Like they really, really are, because it's their lifeblood. So they notice it first. And then by the time it reaches headlines, there's already a trend established. You're going to hear me say that word a whole lot, trends, patterns, and so forth. And so this is just a trend that starts via an increase in interest rates. It hits housing housing, and then it goes to new orders, and then it starts to impact the bottom line of these various companies, and their profits start to drop. And then when the profits start to drop, then the next thing is employment. And it's the lagging piece of this, because it's the last piece of that whole HOPE. And so then you start to see headlines that say, hey, this company is cutting jobs, or, they're laying off, or they're thinking about 2023, et cetera, et cetera. Let me know in the chat if you've seen some of these headlines, or if your industry has been impacted by this. I want to know in the chat. You may have seen a lot of layoffs in tech. A lot of technology companies are cutting back at this point. But this is where we are economically, and it just takes a little bit of time. It takes about 12 to 24 months for everything to really reach its peak. So we're really just starting in this point, and people obviously have seen drops in their 401ks and their retirement accounts and so forth, and we'll get to that piece. All right, so I'm going to move on here to the next. Department stores, layoffs over the past 2 months, truck driver, Amazon, Twitter, Facebook. Yeah. So you're seeing it happen at this point. Now, this is one of the things you're going to see, and I like to share with people, is the stages of a bubble. So on the right-hand side, you have smart money. So smart money would be, people who are moving their money around in a very stealth manner. You don't necessarily know how they're positioned. These are a huge private, they just are very private about this, and it's not something that you can see publicly. So think of pre-IPO money that's going into those different opportunities before it even hits the public markets. That's what happens. And then you have the institutional investors. So institutional investors could be something like a pension fund. It could be hedge funds, et cetera. But they start to move in second. And then third, you start to have the public catch on to different things. How many of you all remember GameStop? What's another company that did that? It was GameStop. There was AMC. You had Bitcoin, right? You remember all the cryptos, and also the NFTs. When these things become very public, think about all of the money that got in early. It's all of this flow of capital that got in very early, and then the public catches on, and then we reach this point where it gets really ridiculous, to the point of people become greedy, and it's going to keep going up, and it's going to keep going up, it's going to keep going up, and oh, this is the new thing, and if you're not a part of it, you're missing out. And then you can see that it starts to drop, right? And it reaches this phase of despair. And this happens over and over. And the reason that I put this inside of this presentation is because as I go through it, you're going to see this pattern, this little wave here. It's like this wave up and wave down. You're going to see this over and over. And I want you to, probably even take a picture of this, because this is how these cycles work in every industry and every asset class. When you looked at, I'll give you some examples. So look at when house flipping was very popular, and then boom, it became this public phenomenon. Like everybody was doing it, dropped off. When the pandemic first started, everybody was trading. That's all you saw on the internet. And then boom, dropped off. And it's going to happen every time you see something that is just what it is. You have to see it for what it is. But every time you see something that catches fire in the public, that's how you know it's like it's coming to a point where it's going to have a drop off. But you're going to see this inside the inside of the charts that we're going to go over, you're going to see this over and over and over. So it's something that is worth paying attention to and understanding. Any questions about what you see here first before I move on to the next thing? Any questions about what you've heard thus far? Yeah, where we are now is we are in the phase of, James asked, where are we now? Where we are now is we're in the phase where you're going to see an increase in layoffs. And that's just that this is a normal part of like it overall. It's like there's a lot of other factors, but you're going to see an increase of that, and it'll probably taper off probably end of 23. Aaron is asking 1 to 2 year period. It'll probably taper off then. It'll speed up first quarter, second quarter, and then start to taper off. And you'll probably see some things come back into norm. But what they're trying to do is obviously have these prices go down. Let me go back one time. So housing got so ridiculous. Housing got so ridiculous. All the prices of everything got so ridiculous. And the reason why that's the case is because whenever there's a supply of money, when everybody has money, what makes a seller whenever it's so much money chasing so few goods and services, right? If there's only a certain amount of houses in the neighborhood and everybody has money because it came from different places, then the price, what is stopping the sellers from raising the price, right? It's just a supply and demand thing. So when there's so much money chasing few goods, and the prices are going to go up if everybody has access to the money. And so the prices have just got ridiculous. You look at the cars, you look at the houses, you look at the goods. I mean, obviously you go into the restaurant. If you look at a farmer can only produce so much, right? And the amount of people that are coming into the world every day, like that's growing and growing and growing and growing. So there's only going to be so much food, right? So it's still this supply and demand thing. Sounds as though by the time the public becomes aware, things are near a downturn. Yep, that's exactly what happens. Or it's not necessarily near a downturn, but it's reaching a peak. But that's what's happening with the money supply. So ultimately what they're looking to do now, central banks, when I say they, are looking to suck the money supply out of the economy by raising interest rates. And what that is supposed to do is bring the demand down by making, and ultimately bring the prices down to some point of equilibrium. We'll see how that goes. All right, so now I want to talk about all of the investable instruments, because there are a lot of people that only think that you can, when you hear investing and you hear long-term and so forth, they equate that to only stocks, but it's so many other things that you can invest in. So commodities, we were just talking about that there are more people being born, and I mean, there's obviously, there's just so much that you're going to be able to produce each harvest season. So your grains, everything that you can think about in terms of eating, pork, all of those different things, you can invest in those on the futures market to, as when the market starts to trend up, you can literally put on a position and ride those trends. Everything that we eat, wheat, corn, orange juice, you name it, you can invest in those. And I just like to expose people to that, like, oh, this is like, you can see the charts and you can see these patterns. And we'll take a look at some of those. Metals, gold, silver, platinum, you can invest in those. And in times when people are fearful, gold tends to go up, right? Because it's seen as a safe haven. And money flows in precious metals because it's something that people can touch. And so that's what tends to happen. and you'll see the market trend up in times of turmoil. And then, gold and platinum and silver, they'll go down when it's plenty of money moving around into other assets like houses and more rich stocks and so forth. Gold and the other metals won't perform as well because people are taking more risk, and this is seen more as a safety. Stocks, obviously, Facebook, which is now Meta. It's interesting because we're going to look at those two in particular, Facebook or Meta and Twitter, to really show you all just how all of this works, to bring it all home. So you have Facebook, Twitter, Walmart, Bank of America, any company that you can think of. Obviously, you can invest in those long term. You can trade them short term, and it doesn't necessarily. What you're going to see is it doesn't just because you think a company is great doesn't mean the stock is going to perform. Doesn't mean the stock is going to continue to go up. But I want to show you the process to get into those stocks and get out of those stocks at the right time. Because one of the things I know for sure that everybody has heard on this call is, or you've heard somebody say it, oh, it's going to go back up. It's going to go back up. Well, what if you buy at 50 and it goes down to 40, and then it goes down to 30, and then it goes down to 20, and then it goes down to 10? When is it going to go back up is the question. You have a retirement date, and we need to have some kind of idea when it's going to go back up. And that's one of the things we're going to talk about. Currencies. Sounds a little crazy, but you can invest in currencies as well. These trend up and trend down. And we'll take a look at this as well. But the dollar, with all of the turmoil that has been happening and around the world and so forth, money has been flowing into the dollar. So the dollar has been relatively strong over the past couple of months, meaning that you can literally profit from the dollar rising in value in the world. There was a point in time when the British pound, for those of you all pretty, well-traveled people on this call, traveled to Europe. There was a point in time when the euro and the British pound was way more valuable than the dollar. And now it's come back to this point where the euro anyway has come back to parity, which means they're kind of equal to each other. Excuse me. But either way it goes, that manifests itself in trends, and those trends you can invest in. You can trade them and invest in them. Invest, and let me talk about those two terms real quick. When it's more when you hear the words trade or invest, it's more a function of time. So invest is more like, long term. People are thinking, okay, I'm going to hold this for 6 months. I'm going to hold it for a year. Trade is, you hear more short term, for a week, a day. It can be any of that, right? But it's really just what your time horizon is. That's literally the difference in the two terms. So it's either you're holding for a longer period of time or a shorter period of time. And my personal thinking on that is, as long as it's growing, right? As long as I'm getting, if 10% is 10%, I would like 10% sooner than later, but 10% is 10%. So it's just a time horizon thing. Cryptocurrency, which is all in the news at this point. The Bitcoin, these are the two main cryptocurrencies, Bitcoin and Ethereum. You go back to the stages of a bubble. The highest point that Bitcoin was at 68,000, and right now I think today it's at like 15,800. So drop in the chat if you recall, not so long ago when everybody was buying Bitcoin at 50,000, 60,000, and there was plenty of hype around that. This time last year, Mila says this time last year. Sean says, definitely remember MLM came out of the woodwork. Yeah, so I think it's worth just looking back really quick. I'm going to go back and then go forward. So this cryptocurrency, right? So 68,000, what happened was you have this right here, right? We just talked about this, where the public caught on to it and then it dropped. We'll get into how do you figure out when it is time to buy again, whether it's stocks, currencies, commodities, that's where we're headed. All right, so everything that I look at personally is price action. So I don't watch the news to make decisions. I don't read any reports to make decisions. I look at what the actual price is doing, because the two schools of thought are fundamental analysis and technical analysis. And so fundamental is like, oh, okay, well, who's the CEO? What new products do they have? What what do they project is going to happen in the business, et cetera, et cetera. Well, to me, those things are all, while they are maybe real, they're subjective to various things. But what is objective is what the price is. We can look at what the price is right here, right now, of any financial instrument that we just went through: currencies, commodities, cryptocurrencies, you name it. If it's Beanie Babies, Reese's Pieces, we can know what the price of that is and whether it's trending up or trending down. And one of the interesting examples I like to give people is that when you pass the gas station every single day, gas prices have gone down, but when they were going up, you subconsciously, when your brain was storing that price data, every time you pass, you're like, damn, it's higher today. Damn, it's higher this week. Because it was storing like little data points to tell you that it's moving higher. And so that is real-time objective data. And that's what I like to use. And that's what you're going to learn how to use tonight. Now, how do the markets move? So the markets move in uptrends and downtrends. And so the market will move in this. This is the pattern. This is the pattern that when I learned that this existed, this is one of the things that really, really, really it just changed my life. And so the market will move up, it will move down, and then it will move up again to higher places. And then in downtrends, it'll move down, up, and then down. And if you notice, the same way that the chart around bubbles is still that same little pattern. So you're going to see that the market moves in these waves, and it'll wave up and it'll wave down. But how do you know when the market is in an uptrend, and how do you know when it's in a downtrend? There's a language, and that language is through the use of candlesticks. So candlesticks, first of all, how many of you all have heard of candlesticks, Japanese candlesticks? How many of you all heard of Japanese candlesticks? I have not. I have. Sean, you got a question?
No, I was just raising my hand and said that I heard of it, but I probably should have put that in the chat.
Awesome, awesome, awesome. I have on my calls. Ooh. Okay. All right, so Japanese candlesticks. So these Japanese candlesticks go back to the 1700s, when rice farmers used them to communicate every 6 kilometers what the price of rice was doing in Japan. And so this has been being used since the 1700s. And I'm going to break down how to read these candlesticks, because that's going to be instrumental in where we're going. So the first piece of it, so the candlestick is going to have a body, and these are going to be the wicks. You'll hear the name of them as shadows, but these are, shadows, wicks. And what that represents is a bullish candlestick is going to open at the bottom. It's going to close at the top. Everything in between is going to be price gains. But it's going to have a low point. This just means that it's the lowest place that it went. And it's going to have a high point, and that means that it's just the highest place that it went. The way that I like to explain this to people, that if I drop you on from a helicopter, you know, whatever, if I drop you from a helicopter onto a beach, onto the sand, and your body is in one place and you take 5 steps to the left, you're going to have footsteps. And if you take 5 steps to the right from that same place, you're going to have footsteps. And so these wicks kind of represents the footsteps, because it's just where the price went but didn't stay. So you're going to have an open, a close, a high, and a low. And these wicks represent where the price went to, but it didn't actually stay there. So this is a bullish candle, and that just means that the price is going up. And this is a bearish candle, which means that the price is going down. So with a bearish candle, the price is going to open at the top, is going to close at the bottom. And again, the wick just represents, hey, this is the high, this is where it went to the left, didn't stay there. And then this is where it went to the right, but didn't stay there. And the price actually closed here. And what this represents really is who is in control. It's going to tell you, these candles tell you who is in control. And what's interesting about this is when you look at CNBC.com or wherever you watch it, what do you all associate with green and what do you all associate with red? Like when you see a green day, what do you think? And then when you see a red day, what do you think? Okay. Sell, red, gain, loss. Okay. So when you have a green day, or psychologically, when people see green, they feel good. If you notice, people say, "Oh, it was a green day," and everybody's happy, and that's what, you know, people associate that with somebody. I gain. The majority of people have their 401ks, et cetera, et cetera. A green day means your retirement account probably did good. Well, the red, people associate that with, oh, it's bad, it's terrible. But the truth is that somebody is making money on a red day. Somebody is making money on a red day. So those colors are psychologically, you know, it's designed that way. So once you really understand what price is doing, and it's just about, it's supply and demand, and it's just showing you who is in control, you understand how to read this, then it becomes you become less emotional about, oh, it was a bad day, it was a good day. Well, it depends on how things close and how things open, which we're headed to. All right, so I know you're probably thinking, like, what does this house have to do with the markets? I want somebody to drop in the chat, how many floors do you see and how many ceilings do you see? How many floors do you see and how many ceilings do you see? Okay, this is good. This is good. So I want you to think about this, everything you're about to learn about support and resistance, in terms of floors and ceilings. Floors and ceilings. When you think about a floor, it's something that is, you know, there's support there. If you fall on the floor, right, you're gonna be supported by the floor. Ceiling, if you bump the ceiling, it's gonna be resistance there. So that's gonna be the highest you can go at that particular point. And so one of the common languages that we use with the markets is support and resistance. And that support means that buyers are supporting an area. Resistance means sellers are resisting a certain area. And so now, does that help? Does that help see this a little bit clearer? I'm going to point it out, but I'm curious for you all, does that help see that a little bit clearer? All right, so you have a floor here, you have a ceiling here. This is the first floor, right? Second floor, this becomes, you know, when you break through this resistance, right? That ceiling, you now have a floor here, and then you have a ceiling here. Well, if you go through this ceiling, then you have a floor here, and then you have a ceiling here. And if you go through that ceiling, you have a floor here and a ceiling here. And that is a common language that we use for the markets. This is the part where it gets really, really, really fun and starts to make even more sense. So this resistance, support, resistance, support, resistance. Somebody drop in the chat and let me know what kind of trend we're in based on that. Up, 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 up. All right. All right. All right. Very easy to spot, right? Now, there's a way to read when the market is at resistance. There's a way to read when the market is at support. And just to go back to this, right? You want to have a green candle. So this is green, this is red. This is letting you know that there's some resistance right there. It's letting you know that the sellers are coming in there. And what you see the same thing over here. So now I'm going to go to this to show you that what is present at these different areas. So resistance, you're going to have a green and red candle. Support, you're going to have a red and green candle. Resistance, you're going to have a green and red candle, green and red candle. And at support, you're going to have a red and green candle. Oh, somebody's off mute. All right, let me know if that makes sense. Does the order matter? Yes, the order absolutely matters. So red and green is going to be your resistance, red and green. Every time you see that, you're going to see some kind of resistance. And so Nori asked me to expound on that. Great. All right. So this is what this means. So when you have a green candle, you have price going up, right? You have price going up. I'll just do all three. You have price going up. So it's showing you that the buyers are in control. And when you have a red candle, it's showing you that the sellers are in control. Showing you that the sellers are regaining control. Does that make sense? And down here at the bottom, the sellers were in control. The sellers were in control. And this is how you read Japanese candlesticks. And now it's showing you that the buyers are in control. The buyers are in control. And when the buyers are in control, we want to go up. We want to go up with them. When the sellers are in control, you know, we maybe want to figure out if we should still be in this market. But that's on the next slide. But I want to make sure that this makes sense first. Any questions about this so far?
Yeah, I guess how do the two of them exist together? You know, at the top of the chart or whatnot, or is it just kind of like either or? Like I think I'm a little confused on that.
They're mostly going to be side by side. And when I go to the next slide and then we go into some live examples, it's going to make a whole lot of sense. A lot of times they are going to be side by side, because if you think about if we say the price of, let's say a price of an orange, and we're going to give the price of an orange a range of 5, like from 1 to 5. So if the price is going up, it's got to go 1, 2, 3, 4, 5. 5, 4, 3, 2, 1. So these candles are going to be next to each other in that way because it's just price. So think of the candles as nothing but this is telling you what the price of any instrument is doing real time. So that first green candle on the right, if we look at this, we can say, hey, the price of an orange went up and then it went down. And that's why they can be side by side like that.
And are they always side by side like that when you're reading the charts? So is that just kind of like one example of it?
Yeah, they're always going to be side by side like this for sure. And you're going to see some examples of that. But because price, the price of anything is going to be, it can only go up and down and sideways. So.
Gotcha. Okay. That's a lot more clear now. I get it.
Yep. You're welcome. All right. Moving on. Got two screens up here, so I'm moving between the two. All right, so remember the two P's that I mentioned. One is participation, one is protection. And everybody loves to get involved, right? Everybody loves to participate. So when they hear, oh, such and such, a stock tip, or they hear such and such, this should do well, or it's going up, or they just think it's going to go up, or they see it's going up, they buy, but they don't think about the protection aspect. But we're going to focus on both, and I'm going to be heavy on the protection because I want you. Yes, I would like for you to get involved and know how to get involved, but I also want you to know how to protect yourself because that's the environment that we're in. So for participation, we want to buy when the candle breaks a ceiling. Just like we just looked at the picture of the house, we want to buy when the green candle breaks the ceiling. So look at this. This is the example. When you have a green, a red, and a green that closes above that area, that is when you buy. When you have a green candle that closes above a green and a red candle, that is when you buy, because that is showing you who is in control at that particular point. All right, over here. So this is showing you right here, oh, the buyers are in control and the market has a high probability of continuing to go up. Does that make sense to everybody? Any questions about that? Yes. So when you have a green and a red, so we remember this is resistance, right? That's resistance, right? So when or a ceiling, when price closes above that, right there, when you have a green candle that closes above a ceiling, we're breaking a ceiling, and that is a place to buy.
Got it, because that's the new floor now, right?
That's the new floor. Well, we have a floor that's going to be that is one of the floors. That's correct. So when price breaks and closes above that area, when you see a green candle that is above that area, then that is a place to buy. That's going to become even more clear as we look at the charts, and it's a repetition thing. So while this may be new information and a new concept for a lot of you, it's a repetition thing. So you're going to see it over and over and over, and we're slowly working into looking at some real time examples. Aaron asks, how long should you be looking at the new high before buying in? We're gonna look at an example, but you only need one candle to close above the last highest point, because what you're anticipating is what's in motion generally stays in motion. So when the market goes up, comes down, and breaks a high point, then what's in motion generally stays in motion when we're talking about trends. So yes, is it gonna pull back? We anticipate that, and then continue to go up like such. So when it closes above that, the first time it gets above that area, that's a great time to buy. Versus when somebody's saying, oh, it's low, I'm gonna buy. Well, low can always become lower. How much lower can it become? I'm glad to hear that, brother. Glad to hear that. That's what it's all about. All right, so that's participation. I'm keeping it really, really simple. This is it, and you're gonna see it on the chart. So when you want to participate, you need to break a ceiling. So if that's the note that you take, to participate, you need to break a ceiling. Now, we want to talk about protection. We want to sell when price breaks a major floor. We want to sell when price breaks a major floor. Nobody really talks about the protection aspect of this. And what this means is, when do you get out of something? Because you can always get back in. You can always get back in, but you don't want to be in wishing you were out. I would rather be out wishing I was in than in wishing I was out. That's my personal philosophy is, okay, cool, I'm not in, wish I was, but I don't want to be in there wishing I was out, and instead of going down and going down and going down and going down. So how do you know when to get out? So remember, we bought here when we bought here, and the market made a floor over here, right? We just don't want the market to break this floor. We anticipate that it's gonna, move in waves, but we don't want it to break the lowest floor that we have. We don't want it to break that floor. We wanted to do just like that. We wanted to pull back a little bit, create a new floor, and then continue to go up. So we don't want it to break the lowest floor that we picked out. We do not want it to break that. If it does, that's where you sell. So your lowest floor, that is when you get out, because you can get back in once it starts to go back up again. So it's like, if you want to go north, do you get on the train going south? If you want to go north and your destination is north, why do you get on the train going south? Right? So that's the thinking behind that. Sean asked, over what time period? Well, the time period is going to be determined by what the price is doing. So that time period could be days, it could be months, it could be, if you're trading, it could be, minutes. But the principle is that if you have once you establish that you're in it, whatever that floor is, you do not want the price to come below that floor. Does that make sense? Okay, break that down.
Like, I get the floor part, but I guess the part that's a little confusing is just like kind of determine like that time window, right? So like, it may be like, was it a floor from 6 months ago, a floor from, I guess 2 weeks ago, it could be two totally different things. So just kind of determining that.
Yeah, the floor, as the price moves up, let's say the price is moving up, you're gonna get new floors, right? You're gonna get new floors as the price continues to move up, because it's gonna go down and then come up. And you're anticipating, that's why I did this one. We want to sell when the price breaks a major floor, because the market is going to move in waves, right? And as it's moving in these waves, as it's moving in these waves, like such, it's going to go up, it's going to come down, it's going to go up. Here's your lowest floor right now, right? That's your lowest floor. The market is going to come down. We don't want it, long as it doesn't come below this floor, we're in good shape. And then it's going to go up, and then it's going to come down, and then it's going to go up. Well, now we're going to have a new floor over here. Well, if it starts to break that floor, then it's time for us to get out of that. So you're going to continuously have new floors as the market is moving up and up and up and up. Yeah, your strategy, Aaron, your strategy is you are buying what is making, you're buying what's going up and selling what's going down. So that is the strategy, whether it's long-term or short-term.
So just so that I'm clear, so we just need to make sure it doesn't go past the most recent floor, correct? So we're not looking at a 5-year analysis, a 1-year analysis. It's whatever the most recent floor is. It should not break that floor, or I'm just kind of piggybacking off of Sean's question, just to make sure I understand the time cap for the flooring. It's the most recent floor.
Yeah, so if you are on a there are all kinds of time frames that you can look at this. So the most common is you're going to be looking at a daily chart, right? And the market is going to be, we're going to look at some examples next. But if the market is moving up, if the market is moving up in a daily fashion and it's moving up and it's moving up, and you start to break floors in this way, like that's a floor, right? If you start to, it's okay to get out of that because you'll be able to get into a new position if it starts to continue up, because you don't know if the whole trend is changing. You don't know if it's doing this to then drop like that. These are great, great questions. And what doesn't make sense here is about to make sense right now. All right, so we're gonna look at some real examples now. All right, so drop in the chat, drop some companies that you are aware of, and I'm gonna pull them up, and we're gonna look at the chart, and I'm gonna break each one down piece by piece. And we're gonna look at let's look at the monthly. Look at the monthly for now. DoorDash. Can you all see my chart, by the way? Can you see my screen?
Yes.
All right, great, 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 great. So this is the monthly chart, right? The monthly chart, this means that each one of these candles is representing 1 month of price. 1 month, like June, June, July, August, September is representing 1 month. So can you see now that this is going back from 2021, and this is where we are right now over here to the right side. So you read everything from left to right. So this is the left side, this is the right side, this is like real time what's happening right now. But now you can see that the price went up, right? This is DoorDash, went up even higher. And when it started, this is your most recent floor, right? That's your most recent floor because you have a bearish and a bullish candle. And look what happened when it started to break that floor. Look what happened when it broke that floor. Look what happened when it broke that floor. And this is the highest point was $250. And now it's at 56. And you see is that starting to make more sense to you all? Like in terms of floors and ceilings, when you start to break these big floors like this, there's a high probability that it's going to continue to go down lower. Versus somebody was saying, oh, it's gonna come back. At what point? At what point is it coming back? If you bought just because at 220, or just because at 170, or just because at 150, well, now you're at $55. And that we don't know if it's ever gonna make it back up to 250. Some companies do, some companies don't. All right, so we're gonna look at some more examples again, because this is a repetition thing, and you have to see it over and over and over, and it really starts to make sense.
Hey, next example, can you show, like, I guess, where you would have bought in at and where you would have sold at, just kind of based on those patterns that are showing?
Yeah, if it's like DoorDash, also, let me say this. When there is a IPO, I stay away from IPOs. I think this DoorDash was an IPO. Sure, it popped up, but look at it now. It come out of the gate hot, but we'll look at a couple of those too. But I stay away. This was an IPO. Look at it, doesn't have any data. It doesn't have any history before 2021, right? So it doesn't have any history. So I just stay away from those because it's got to have established some history for me to be interested. You're really paying retail. If you buy an IPO, what you're really doing is paying. Remember the stealth investors, and then you're institutional. Those are the people who got the right price. They were in syndicate investments, and then the public came in when it reaches IPO status. That is the public. So you're in paying for a retail situation is what it comes down to. So let's look at AT&T. 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 Which one is AT&T? What's the ticker? Oh, there it is, T. So you can start to see that it moves. This is clearly, somebody drop in the chat, what trend, where is this in the trend cycle? Is it downtrend or uptrend? Downtrend or uptrend? Down, 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 down. You can clearly see, right? You can clearly see. Let me just draw it out for you, and you'll start to see it even more clearly. We have a break right here, right? It's starting to come down. What did it do? Come up a little bit, break more. What did it do? Come break a little more. What did it do? Break a little more. So this is not something I want to buy. It's not moving up. It went from 33 to this area, and then what'll happen is people will go, looks like it's going up, so I want to buy, or I think it's at a low point. Well, we have just saw that low can always become lower. Low can always become lower. That's what we're looking at, is low becoming lower. So you have to be careful with that. And when it's in an easy way to spot this, if it's at the bottom, if it's over here, bottom right hand side is going down, top right hand side up, on the upper right hand side is going up. Does that make sense? Because it's in an uptrend, you can see it going that direction, but when it's going in that bottom right hand side, you can clearly see it's going in a downtrend. Let's move on to, there are not many stocks I will buy, right? But that's another story. But there is one that I think we should look at that will roll out. Amazon. Let me know if this is if it's starting to make sense now that you're seeing it with real companies. All right, so this is Amazon. And you can see that it is two here. All right, so look at this. It made a high, it was here, it was trying to go, but guess what it started to do? It started to break down. And when it started to break down, I had people ask me, like, oh, what should I do here? I was like, well, you know, it looks like it's looking real sellish. And it just continued to go down, went up a little bit and continued to go down. Where is it going to stop? Where is it going to stop? Right? We do not, it's coming down. So there's, if it were going up, then it would be green and it would be moving to the upper right-hand side of the chart, but that is currently not something that you see there. So you can't, if you're buying, you don't know, you're not using momentum. You're not using buying momentum to your advantage, and you don't know where it's going to stop. All right. Let's see. Let's keep going. Let's keep going. Somebody said somewhat is helping. Okay, let's keep going. Amazon, Airbnb. Let's look at Airbnb.
I have another question while you're doing that, and you may have already explained this, but so like the long stems, like the wicks, I guess, of the candlestick, what are we looking at that in our assessment as well, or are we only looking at those bold, I guess the bold part of the candlestick?
Yes, my suggestion is, there's obviously another level of detail as far as like understanding wicks and so forth. But when you're looking at the candle, the bodies of the candles, the closes, that is showing you where the price opened and where it closed. The wick is just showing you where the price went to, but didn't close at that area. But when you look at the big bold areas, that's showing you where the price went to but didn't close. I mean, that's showing you where the price closed. So if you look at Airbnb, first of all, did that answer your question?
Yes, it did.
Okay, great. So when you look at Airbnb, it was an IPO as well. And it came out, what is this? December of 20. It came up, made a high, made some noise. People, ride it to the moon, like 218 bucks. And then it started to come down. It never could come back. It never could break this ceiling. It never could break this ceiling. See this candle that tried to break the ceiling, but it didn't. And then it started to come down and then come down. And then once it started to break this floor that's over here, 149, like 149, now we're at 95. So that is what happens over and over and over. And you start to see these things, and you'll be able to ask, whether it's your investment advisor or you're doing this for yourself, you'll be able to make better decisions, because on the right-hand side of this chart, it's still going down. So until you start to see it going up and making higher points, breaking higher, breaking ceilings, breaking ceilings, breaking ceilings, you're not using momentum, in your favor. Does that make sense?
Yes.
All right. Let's look at a few more, and feel free to ask questions. But the goal right now of this call is, one, I want to make sure that we're on track. I want to make sure that you are seeing how to. Obviously, a lot of these stocks have been in a downtrend, right? So they're not presenting buying opportunities. A more sophisticated, if you will, concept is profiting from markets when they fall. So it's called short selling. That's not something that we're going to cover on the call, but we don't have time to. But you can profit as these markets are falling. Remember, on red days, there's somebody making money as well. And that term, if you want to look it up, is called short selling. But as these are falling, somebody is profiting. Let's look at a few more here. Oh, you know what I said I was going to look at? I want to look at Twitter. This is a good one. So Twitter. Is Twitter's situation. Erwin, this is what I'm using to look all of this up is called TradingView, tradingview.com. It's free software. I mean, it's a free website. You can use this to look at these charts and so forth. And, it doesn't cost you anything to do that. So look at, this is Twitter, right? So it's up, 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 up. And then once it broke that, it came down a little bit. Now look, does it look like it's about to break a ceiling? So this, Sean, to your point, the question that you was asking, like, okay, can you show me one where it may be, something that you can buy? Well, this right here if it were to close, you have, this is a monthly candle, so you have another 9 days or how many ever days left in this month. If this were to close above this ceiling, then it's a buy, and there's a high probability that the price is coming higher. So that's how you think about like probably in terms of, okay, 1, 2, 3, what am I looking for? Or am I breaking a floor? Or am I breaking a ceiling? Am I breaking a floor? Or am I breaking a ceiling? And you're always looking for that. But this is a good example that, hey, you know, Twitter it was acquired by Elon Musk. We don't know how that thing's gonna pan out, you know, whatever the case. But with everything that's going on with it, the stock has been moving up. It's up 14% this month. The numbers are over here, and then when I put this on top of it, it shows that it's up 14% this month. So, and this is us just looking at the monthly time frame. When I'm operating on a day-to-day basis, I'm looking at much smaller time frames because I'm not necessarily holding these for a long term. But my promise to you all was to show you how to view your long-term opportunities, give you a strategy to participate in long-term opportunities, and then to know when you should be exiting. One of the hardest things for people to do is to get out, because they think they have this, you know, it's this hope that it's going to come back up. And as you can see, some of these ain't coming back up. They haven't started that process yet. So I'm going to look at XOM next, but let's look at what's another company. Let's look at Coinbase. I think this is good. Just to get this idea. I want this idea ingrained. What is it doing? It's clearly in the downtrend on the right side of that chart. It's dropping. And from 400 to 41. So even somebody saying, oh, well, you know, I'm just going to buy right here at 251 because it's going to go back up. Well, low can always become lower. So I want you to think participation second, protection first. Like, I'm always thinking about how can I lose less or not lose? What makes sense around that? I think I promised XOM. Now I want to show you all I want to show you Bitcoin. I want to show you some commodities. Now look at XOM. It broke a ceiling. It broke a ceiling. It's been this right side of the chart. This right side broke a ceiling right here. So imagine if it broke a ceiling from at this 64, and this is a monthly chart, but buying at 75, your protection is 56. Now, when you think about this is great example. Who shared that again? Great example. Who was that? Yvette. Okay. All right, so this is a great example. So look at this area right here, right? This is it breaking a ceiling. This is a ceiling. Everybody agree that this is a ceiling? Does everybody agree that that's a ceiling? Over here, grab this. Here. All right. And can everybody agree that this is a floor? And this is where the candle closed, and that's a buy. And the protection is down here. That means that, hey, if it drops below that area, I'm out. But look what happened after that. And that went from 76 to 110. So that's probably what, 25%, something like that. So, and that's just that was one opportunity based on that. Great example. But I want to make sure, I didn't see enough yeses, so I want to make sure that this makes sense. This is a ceiling. You have a green and a red. You have a closed candle above that ceiling. Here is your floor. You have a red, green right here. And the market just continues to go up. So then you have a ceiling up here. This candle closed above that. Here is your floor right here at 84 bucks. And you just would anticipate that the price is going to continue to go up from there. And it's not one of those things where you are you're putting on you're putting on a position at that point that says, hey, there's a probability that this thing has a higher chance of going up. And here's my protection that if it doesn't, then I'm out there and that's all I lose, because I don't know if this thing is going to then continue to go down and down and down and down and down. And that is how you protect yourself, because you would rather be out wishing you were in than in wishing you were out. Let's do one more. Oh, let's do this. Here's a great example. Let me know if you're getting some clarity from this at this point. This is Bitcoin. And we're going to look at commodities. We're going to look at commodities. What is it doing? Get this. Just, I had this on there from who knows when. Breaking. It's continuing to move down. So that's Bitcoin. Let's look at wheat. We want to see what wheat is doing. Let's look at wheat, and then we're going to look at lumber. So let's look at wheat, see what wheat is doing. Oh, well, you know, wheat hasn't broken the floor, but look at it from 20, from 20, when those prices was just going up. You didn't hear about lumber until 2021, right? Or some early 2022. But in the meantime, it was already breaking ceilings. It was already breaking ceilings. It was already breaking ceilings. And now it got really, really crazy and just started to come down. So at this point, you know, it looks like it could break this floor and then continue down. But you already have an established ceiling that if it breaks that ceiling, there's a high probability that it's going to continue to go up. And that's exactly what you're looking for, floors and ceiling. What did I say? Lumber. Same thing. Lumber went crazy all the way up. And then once it broke this floor over here, it just started to crash. Don't mean that, you know, builders and so forth, like, you know, lowered their prices, but the amount, the actual price of the thing, of lumber went down. Monica asks, is it best to do a monthly view or a daily view? It depends on your time frame. I'm just really sharing the monthly perspective to show you that this can be done on the longest time frame that's out there, which is the monthly. But you can look at daily, you can look at the weekly. If you're mostly going to be positioning yourself to hold for a month or a few months, daily is going to be fine. Weekly is going to be fine. What we particularly do, or what I do, is marry the different time frames, which I'm looking at all three time frames to get some alignment. But that's just, you know, that's just a more advanced thing. But looking at it from a daily perspective or a weekly perspective should be fine for you. It's still just going to be floors and ceilings. Somebody had a question? All right, and we'll look at one more. If you have a suggestion, we'll look at one more, and then I'm just going to open it up for questions. And again, I want to, before you get off this call, I want to make sure that you, if there's any questions about how to participate, how to go up, how to get into a stock or any instrument that's going up, and then when to get out. Sean said, take it slow on the floor on the last one. All right, let's see. FDX, Mario Coleman. It's FedEx. All right, let's take a look. So that was the last floor, right? And you see how it dropped off? So now it's going down. It's on the right side of this. Everything over here is saying lower prices. There's nothing saying that it's going up. You don't see it breaking any ceilings. It's only breaking floors. So only breaking floors. This was the last, let's look at this as, this was the last ceiling that it broke. So let's say you bought here. Well, at least you didn't, at 320, at least you got out as it broke this 320 around what, I guess that's like 240, 220. And you didn't suffer continuing to let it drop to 160. So you bought here and you got out here. And then after that, there were no additional ceilings broken. It was just all floors after that and continuing down. And that is how you get out of those before they get out of control. Because once you get to a point where you're in an investment that's 50% down, then what people go into, they go, well, I mean, I might as well hold it now. Well, then that could become 75%, 80%. And you reach this point where it's like, well, I might as well just stay in it. And then they forget about it and they say, oh, that's my long-term one. And you see that a whole lot.
So on the ceiling, does it have, because like I'm looking at, I know you said it only broke floors, never broke ceilings. So does it mean like if it doesn't hit, I guess that break that highest ceiling that has ever been, I guess within that time frame, is that like, do the ceilings start over?
Great question. Great question. Just how we looked at what was that company?
XOM.
XOM. Look at XOM real quick. If it's going to start to go up, if the market is going to start to go up, then what you're going to get is you're going to get it moving up and it's going to create a high point. Remember that's this pattern is going to create a high point like such. It's going to create a ceiling. It's going to create a ceiling for you to break. It's going to create a ceiling for you to break. So your question about like, okay, well, I've been seeing all these moving down. Well, if you think it's moving up, wait for it to create a ceiling and then break that ceiling. And then you're going to have a high probability that it's going to continue to go up.
So in this example, like right before 2022, where the ceiling was at $60, if we buy in right there, because it broke, it was a resistance at 56.55, and then we buy in at 60, would be the time to buy in because it.
So here, you're talking about this area, right?
Right there, we have that ceiling at what, $52, $53? I mean, I'm sorry, the floor. The floor. Yeah. So we see the floor here, and then it creates a new ceiling there at 60. So it's safe to buy at 60, or is it safe to buy once it gets up to the 68, or
The 68 is the best place. So
okay.
So look at, let's even think about that. If this closed, it didn't, but let's say this area closed above this, right? This green candle closed above this red candle. Let's anticipate that, right? Or just think about it in that way. And that's your break of that ceiling. And now you have this floor here. Look how that next candle pulled back and then took off. So that's the protection piece I'm talking about, is that by looking at it and saying, hey, I want to wait for it to break a ceiling. And even if it pulls back, we have a area that's protected by buyers, that green candle, that once the more buyers come in, it just goes up and you don't get taken out of that trade or the investment. That makes sense?
A little bit.
All right. So the better situation is this. The same one that I mentioned. When it closed above the ceiling, clear close above that ceiling. That's clear, right?
Yes.
and then you have a floor here, right? If it looks too difficult, then you wait for something that's very, very clear. Here's your buy here, here's your protection down here, and now this is continuing to move up.
Got it.
Same thing over here. This is a clear break of that ceiling, and here is the buy. The protection goes under here like 82, 87, and you don't know how high this thing is gonna go. Nobody knows how high it's gonna go. Nobody. So you have to allow it to, depending on what's on the left side of the chart, which is just a more, just more technical stuff. But when there's nothing over here to the left, this thing could just continue to go and continue to go and continue to go. But we have the protection in place, and then we have a proper way to get into it, proper way to protect ourselves, and then we let it roll.
So as a repeat, so if I bought in at that clear close that you have there, right? The 78, 75, my protection is that red candlestick at 60. I
Your
would sell if it goes
your protection is under that.
under that.
Under that, right? Under the red. Remember the graphic was
Resistance, support.
support, right? Support, right? So you need you have a red candle. That's showing you that your sellers came in, and then you have green candles. That's showing you that buyers came in. So you want to be under the area that buyers came in. Not right at it, but right under it. Right here is a good place to have your protection, and then the market continues to move up. Because again, this is a game of who is if you look at it as like who is in control, and you can tell who is in control by what floors are being broken and what ceilings are being broken. If the ceilings are being broken, the buyers are in control. If the floors are being broken, then the sellers are in control.
That makes sense.
All right. So right now it is 8:28, and I'm grateful that y'all have spent this time with me. I want to open the floor up for questions, or any last questions. I also want to know if this was helpful. Was it insightful? Did you learn something new? Did you learn something useful that you think will be useful to you?
My question would be is outside of like just going to this website, is it like any like I guess resource to where we can just kind of get more practice of just kind of analyzing more, kind of more in a safe space to in that way, just to kind of, build that muscle memory or to easily identify, where those breakpoints happen at.
Yeah, I would. I think the best thing that you could do, is, if you like understanding the candlesticks, understanding really what it is. It's buyers and sellers. It's supply and demand, and it's easy to overthink it in terms of it's buyers and sellers, and the colors. The colors are green and red. Understanding that and then watching price is going to be the best thing for you, and keeping it simple. What I've given today is the most simple way for you to participate and protect yourself. That was my goal. Is I want everybody to have a very simple way to operate. What I do one-on-one with people is more in depth and more. There's another level of precision, and happy to obviously work with anybody around that and speak more about that. But the three key components are management, like psychology, your methodology, which you have now, your psychology, which is keeping it simple. What'll happen is when price comes back down to those, I'm not making this like, oh, it's easy and you got it and you can go for it. If you keep it simple, it's a lot easier. But when that price is coming down, your real money is on the line and it's about to hit that area. Somebody, you know, people go, oh, well, I'm gonna see if it's gonna go down a little bit more and then turn around. And that's what makes it difficult. So having the proper psychological framework is important. Having the right mechanical framework is important. That's the strategy. And then the last piece of that is risk management, which I really gave you a crash course on that, which is how do you protect yourself? How do you protect yourself? Risk management is how do you protect, if you start off with $10,000, you're never putting $10,000 at risk. We're putting putting a small amount of that capital at risk, and then saying, hey, if it hits this area, get me out. I would like to be out at this area versus I hope it's going to come back. We see, just hope is not, I firmly believe that hope is not a strategy. You got to have a strategy. And I think what I'm going to do is I have some crash course videos on the candlesticks that I can send out, that I'll send out to everybody, and you can watch that. Other than that, I'll also include a link to schedule a one-on-one. It'll be one 30-minute complimentary one-on-one. And other than that, I'm happy to work with you one-on-one as a coaching client as well. Other questions? Candlesticks, brother, candlesticks. That's what I want to say.
I did want to say, hey, it was very helpful. I think it was helped to bring a lot of stuff together, especially for me. So did just kind of want to come out on the air and say that since you're recording it. Hopefully that helps out in some kind of way, but it was a very, very helpful session.
Awesome. I appreciate y'all attending. I am going to, I'm going to get this uploaded. It is recorded. I'm going to send it out. And the only thing I ask is that you share it with a friend. And at a minimum, at least people have a little bit more insight about the decisions. They'll be able to ask better questions. They'll know who's doing it, who's not. All right, I want to do this. I don't want to do that. And just at least be more informed to make better decisions in the future. So that's it. Thank you again for spending the time with me. Today is 11/21. I'm gonna get this out, and I hope you all have an incredible holiday season, and would love to hear from you. All right, talk to you in a bit.